Self-employed and commissioned salesmen, beware. Hi, I'm Tim Whitmire. I'm a senior mortgage banker at First Integrity Mortgage. If you are self-employed, earn commissions or bonus income, have any type of varying income, or have recently changed jobs or your source of income is changing, and you are looking to purchase a home in the near future, this is a very important video for you. Fannie Mae, Freddie Mac, FHA, USDA, and VA, they all have very similar guidelines when it comes to what income can be used and how income is calculated. I want to give you a heads up of what to watch for. Starting with self-employed borrowers or buyers. Generally speaking, borrowers must be self-employed a full 2 years prior to being able to use their income to qualify. Even if you are immediately successful and earn a great income, you must have a 2-year history prior to using that income to qualify for a mortgage. It is also very important to understand that we must qualify self-employed borrowers with their gross adjusted income. This is income after all the write-offs. A challenge self-employed buyers often face is qualifying for a mortgage with their adjusted gross income. You naturally want to and should take advantage of all legal tax deductions. However, by doing this, you are also lowering your taxable income and making it more difficult to qualify for a mortgage. Those who earned a 1099 type of income instead of a W-2 income, and those who also own 25% or more of a company are considered to be self-employed in the lending industry. Commissioned and bonus income. Fannie Mae, Freddie Mac, FHA, USDA, and VA also require a 2-year history of commission or bonus income before using the income to qualify. If the majority of your income is commission or bonus, qualifying isn't too different than being self-employed. If you have a guaranteed base income plus commissions or bonuses, you can use your base income to qualify without a 2-year history. I also find it that those who have this type of income many times have unreimbursed employee expenses written off their tax returns. Unreimbursed employee expenses written off your tax returns directly reduces the amount of income that can be used to qualify. This can have a significant impact on what you actually qualify for. Varying income. If your income varies or fluctuates, this can also present challenges. If you work in the construction industry and work overtime in the summer, but have layoffs or less hours in the winter, we also must average your income over a 2-year period. The same goes for seasonal employment or those with a second job. Any type of varying income must have a long enough history to establish an average income for qualifying. Changing jobs or source of income. It is important not to make any changes to your employment during the loan process, even if you take a very similar position with another company and earn a greater income. Making this change during the loan process will without a doubt cause delays. At a minimum, we must document a full 30 days of earnings prior to loan approval. Depending on circumstances, 6 months or more could be required. Fannie Mae, Freddie Mac, FHA, USDA, and VA all have very strict guidelines when it comes to qualifying income. It is important to work with an experienced mortgage professional who understands these guidelines and to start the pre-approval process early to learn about and prepare for any challenges you may face. Call me today, 314-402-8184.